Welcome to January 10th, the market update desk with Scott Riley, NMLS 157524. We have a very red day across the board in all the markets. Dow is down 600. 10-year bond is up to 474. We'll talk about that more in a minute. 30-year bond, in fact, popped above 5% in intraday trading. WTI crude oil is up. Let's break down what happened, what's going on, and what's the effect. So the BLS jobs report came out today, and as I expected, it was going to be a blowout from expectations because of the seasonal adjustments BLS does in January. So BLS tells us that there were 256,000 jobs created, and that's above the expectation of 160,000. We did get a small revision to last month's of minus 15,000 jobs, but that was pretty insignificant compared to that number. But when we look at in depth on this report, the seasonal adjustment was so big that the BLS did that if there was no seasonal adjustment, we'd have minus 81,000 jobs. So we've got a lot of questions on this, and we fully expect that in March with the QCEW quarterly census on earnings and wages, that we're going to see a significant revision. In fact, right now the projections are that 50% of the jobs last year, 2024, were never there. They were air. They were just BS. So more to come on that when we get more data. With the jobs report, it was actually strong because there should be some seasonal adjustments, probably not to the extent that we saw from BLS. What they gave us was government increased 33,000 jobs, healthcare 46,000 jobs, education 34,000, which is kind of strange because we're in the middle of the school year, and I don't see why there'd be that big of a jump in educational jobs. Leisure and hospitality still going strong at up 43,000. Now, the U3 unemployment, that's the headline unemployment, fell 0.1% to 4.1%. The U6, which is the all-in unemployment, which is from the household survey report, fell actually from 7.7 to 7.5%. Once again, it was a strong report. In fact, when we look at the household survey report, which generally shows significantly fewer jobs created than the headline number, actually showed 478,000 jobs. But when we look a little deeper into that, what's very interesting is that employees 16 to 19-year-olds accounted for 224,000 of that 478, basically 50%. What that tells us is it's seasonal, it's part-time, so not necessarily the jobs that are going to project strength overall in the economy. The unemployed, the number of weeks unemployed, in other words, how long it took someone to find new employment after being let go, increased again in December from 23.6 weeks to 23.7. Well, it doesn't sound like a lot. We have been seeing an increase in the length of time people are on unemployment, and that's indicative of reviewing and looking at the continuing claims, which remain to be, last one was over 8 million. So those things did not help the bond market between the stronger than expected jobs, lower unemployment. This is, it's creating a stronger than expected employment market, which creates some wage pressure, which creates concern for inflation. The only positive as far as bond market that came out of the report saw just a little weaker in earnings. In fact, average weekly earnings dropped year over year from 4% to 3.9, and average weekly earnings, average weekly total earnings dropped from 3.7 to 3.6. So the average hourly earnings came down a tenth, and average weekly earnings came down a tenth. That's the only thing the bond traders can hang their hat on this. So this is not unexpected. This was what we were thinking was going to happen with the January report. We're going to see probably a lot of these jobs taken away once we get to February and March through negative revisions and the QCEW. So watch closely. Now, we won't get back the hit that we got to the bond market because we never get that back, unfortunately. When we look at the bond market, the 10-year bond is at 4.75 right now as we speak. There is no resistance from here up to 5%. So there is a very big concern about where we're going to go in the bond market. Now, if we can close above 4.7, we've got a little bit of hope of clawing some of this back. Yesterday, we saw Michelle Bowman give a speech where she talked about she doesn't see any rate cuts this year. In fact, there could potentially be a rate increase. Austin Goolsbee spoke today, gave us a little bit of help, but couldn't overshadow what's going on right now with the jobs and also with Michelle Bowman's comments yesterday. Now, keep in mind, Michelle Bowman has been wrong more often than she's right. She doesn't have a deep background in banking. She worked at Mommy and Daddy's Bank and then magically got put on the Fed Reserve. It's amazing how those things work. So we're going to be very on guard from here on. I don't think we'll get a lot of movement back to the positive probably for maybe till the end of next week. We do have some opportunity next week to get some benefit. We've got inflation data in the CPI, PPI, and also we have retail sales. Depending on where those go, that's gonna direct us probably for the next 2 or 3 weeks. Hope this helps out. Give us a call. We'll break this down more if you need to. We're on call this weekend helping buyers get pre-approved. 616-293-2189. The Market Update Desk is your original singular market news source for West Michigan.